Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Ruben Wilcock of Blackfinch Ventures to talk about the Blackfinch Spring VCT. Hello Ruben, welcome. Firstly, could you give us a bit of background to Blackfinch Ventures and the Blackfinch Spring VCT?
Great, yes, good to be here again, Jonathan. So Blackfinch, we're a multi-asset investment specialist. We've got over 600 million assets under management, and I head up the ventures side. So we're quite unusual as a ventures team because we're really a team of ex-founders. We've all been there and done it before. I think we've got 12 companies between us on the team, and we're supported by a big external network of venture partners with similar type of experience. And we have an EIS and a VCT, and we're talking about the VCT today. And the VCT launched about 18 months ago. So we're kind of lucky, we're fortunate because all the investments we've made have been in companies after the pandemic started. And we're looking for exceptionally talented teams, super talented teams, really exciting, high growth, high tech companies to invest in, but companies that are doing good in the world and are working towards a sustainable future. We've got 13 of those in the portfolio today.
Okay, and your own experience?
So my experience, I've got a background in academia, in startups and startup acceleration. So I've got a PhD in microchip design. I've published papers in many different areas, from genetic algorithms to hydrogen fuel cells. And then I sat on the intellectual property panel of the biggest engineering faculty in the country, actually, and I helped them spin out, license, commercialise and patent their technology for 5 to 6 years. And then one of my companies, I founded 4 companies, one of my companies exited, it was a company called Julo in 2014. I set up an accelerator called Future Worlds, and we helped about 50 to 60 companies launch through that over a 4-year period, and then I joined Blackfinch. And my experience is not unusual on the team. So we've got James Bruckner, who's founded 3 companies. He's got 10 years experience in venture capital. Richard Kirkhour, CEO at Blackfinch. He's a really fantastic entrepreneur himself. He's very involved in the ventures team.
And with the VCT, what sort of companies are you looking to invest in?
So we're looking to invest in companies that are all over the technology sectors, companies that have really good, sticky, recurring revenues, companies that are driven by really impressive teams. Companies, some of them come from our EIS Portfolios product. That's a really good benefit of having that fund as well. But these companies, we're looking for companies that have founders that are so visionary that they can really disrupt sectors through their technology. And so we've got 13 of those today. We're investing at a rate of about 10 a year currently.
So you mentioned management teams there. What makes a good management team? What are you looking for?
So, track record is a great thing to have if you have track record. So we've got a few founders where they've been there and they've done it before and they kind of know, they understand what some of the challenges are, and it helps them succeed second time around. But what we're also looking for really is we encapsulate it by saying we're looking for a hacker, a hustler and a hipster. So the hacker is kind of like your CTO, someone who's quite nerdy, super into the product, stays up late into the night to get it absolutely perfect. And then you've got your hustler, quite often the CEO, and they're really good at closing deals. They're the sort of person that's really passionate, really driven. They're able to get A players into the company, close those big deals. And then finally, a hipster. So that's the person that understands growth, someone who understands user experience, go to market, and really knows those kind of growth hacks to build the company and make it a success.
And do you have any recent examples of companies you've backed in the VCT?
Yeah, I will tell you about 3, and this is the bit I enjoy the most, talking about the companies we've backed. So the first one is a company called Cycler. So we have a sort of analogy with Cycler, which is that during the gold rush, the people that really made the most money were the people selling the picks and shovels. And Cycler is really a company that's equivalent to that, but for the software as a service revolution. So if you had a company that sold a piece of software, you might well have a client that says, or potential client that says, you know what, I'm not going to buy this software until you integrate it to Salesforce or Pipedrive, or maybe make the notifications show up on Slack. And that's what Cycler does. So you can make one integration with Cycler, and then you can very easily connect to over 300 different software platforms so that you can make that decision about selling to clients that need those integrations very, very quickly. And that company has done really, really well. So we invested in April. They've already grown by, I think, over 75%. And it's really the shape of the growth curve. It's an exponential growth curve that we're looking at there, which is very exciting. So that's the first one. We've also invested in a company called OnePulse. So if you're a big brand like Sainsbury's, for example, and you're designing a new sandwich packet, then you want to understand what your customers are going to think about that design. And what they often do is they do market research, surveys, things like that to understand those sort of factors. With OnePulse, they have an app with over 40,000 people in their community. And in that design meeting, you could go to that app and you could get a survey response within 5 minutes from 100 people, which means that it's kind of addictive for brands to know exactly what their customers think all of the time. So again, that's done really well. That's a company that some VCs would have overlooked on the investment side because it had quite a complicated background. It had quite a complicated cap table. They'd changed the CEO about 18 months before. And one of the things I think we're good at Blackfinch is being able to look at those quite complicated situations and help them sort of fix them if we think it's worth it and work towards a really good investment proposition. And that company has grown again, I think about 50% since then, but Q4 is really when it's going to ramp up with that company. So another one is called Culture Shift, and this is a company that really well aligns with our ESG values across the whole of the Blackfinch Group. And this is a company that has a platform that addresses bullying and harassment in the workplace. So it allows companies and organisations to very easily report incidents of bullying and incidents of harassment, and then they go in and help them address the culture. And we really like this company for lots of reasons, but one of the reasons was that when we invested in it, they had completely dominated the university sector. So I think they've got almost half or maybe more than half of the whole of the university sector. And not only that, but when they came to renew those contracts with those universities, often increasing the price of them as well, none of those universities churned. And that shows us incredible product market fit. It shows us people really see the value in this product. I think they were growing 5 times year on year when we invested. Brilliant founder, Gemma McCall, and everyone in that company, we interview every person in the company when we invest. Everyone is fully aligned to the values of the company. So we're really excited to see where that goes next.
So some good recent examples there. Do you have any examples of earlier investments that you backed? I know it's still a relatively new VCT.
It's quite a young VCT, as you say. I think we made the first investments just over 12 months ago. But one of the early investments is a company called Spotless Water. Mm-hmm. So if you get your windows cleaned, most people do, then you'll probably have a window cleaner that uses a pole and a brush. And you've probably seen kind of the water squirting out of the brush as they clean the windows. And not many people realise, but that water is really ultra pure, zero total dissolvable solids water. It almost sucks the dirt off the window. And the thing about Spotless Water is they are really the only nationwide network of stations where window cleaners can get that water. And it's a really impressive tech company because they've developed all of the water purification technology, they've developed all of the payment side, and they even have data scientists working on where to put the next stations. And then we have another good example, an early investment in the VCT called TransReports. And so they have a B2C ticketing and passenger assistance app for the rail network. So if you're a person of reduced mobility, you need you have to be able to get around the rail network just like everyone else, and you have to be able to tell the rail operators what sort of support and assistance you need. And this company has the whole kind of rail network exclusively tied up in a contract, and we thought this was great, again, perfectly aligned with our ESG values. They've grown from, I think, about 5,000 users of that app earlier in the year to 50,000 today.
So how has the pandemic affected your portfolio?
Yeah, so it's been, again, because it's a young VCT, we're lucky because we were able to, make our first investments after COVID hit, and I think that's a real advantage of what we have to offer. But what we did in Ventures is we helped our companies to plan their cash flows, look at their product design, maybe scale down marketing a little bit. But we also did something quite unusual. So with my background in academia, I kind of realised that you had all of these students, these talented postdocs, these academics sat at home wondering what to do, not being able to go into the lab. And we had all these startups that needed all of this kind of special help to get them through this difficult period. So we created something called Isolation Intern, which was a marketplace, an intern marketplace that connected those two sides together. And it meant that startups could get the benefit of these super smart people from academia, but equally people from academia could get experience of working in some of the high-tech, most fast-growth companies today. And that worked really well for our portfolio. So we had a company called Tended who took on 2 of those interns, and they got those interns working on a prototype to win a very big sort of rail contract across the UK, which they did win. So that's really helped them. And Tended as an example of a company during the pandemic is a really interesting one too, because they make safety and security wearables, kind of like a wristband that detects if you have a fall or you have an accident and you're a lone worker in a very big company, and then your boss can be alerted and come and help. And Tended, when the pandemic hit, Tended said, well, we think we could actually pivot our technology and build in distancing to it so that it could be a hardware-based social distancing solution. And they did that in about 3 or 4 months, an incredibly quick time for a hardware product development. And that helped the likes of Rolls-Royce and Nestle get their employees back to work on the shop floors, in the factories, but in a safe way. So a great example of a company, I think it grew 20 times during that period, that did really well during the pandemic, but helped the economy and people get back to work.
Yeah, that's really interesting. So you gave an example then of how you look to add value to your companies. What else do you do practically to try and help your companies succeed?
Yeah, absolutely. So we have, as I said, we have a team of ex-founders. So we've got a lot of hands-on experience in helping the companies ourselves, which is great. We have a good network now of founders in our portfolio. We connect them all together. We find that one of the biggest values you can create in a portfolio is to make founders talk to each other. And we do that on a very regular basis. But then most of all, we have an external network of venture partners, we call them. These are people who have really been there and done it before. They're entrepreneurs, maybe exited for hundreds of millions, or they are industry leaders. We've got people like Seb Chakraborty. He was founder, CTO of British Gas Hive. He was then CTO of GoCompare before it exited for 600 million. And now he's CTO and on the executive team at Virgin Media. And he sits on the Tended board, actually. So these venture partners come into the companies and they sit on their boards and they add huge amounts of value to those companies. And in the case of TransReport, which I mentioned, there was a case where actually we looked outside of our existing network to find the perfect fit for their venture partner, for their director on the board, their non-executive director on the board. And what we did was we went to the Trainline, which is a similar type of app, and the person that set that app up and sort of built that app and launched it, that wasn't working there anymore, we approached them, and now they're one of the non-executive directors on the TransReport company. And that's just a great value add for those companies.
And so investing at such an early stage is fairly risky. How many companies do you expect to fail?
Yeah, so you're absolutely right. It is, in terms of an asset class, it's a risky asset class. That's why we have the tax reliefs. Yeah. And so you have this interesting situation, because you have the asset class, which is quite risky, but the potential for high returns. And then you have the tax reliefs over there. And how do you reduce the risk? How do you mitigate the risk? So we do it in a few ways. First of all, through selection. So we make sure that we're looking at companies proactively through research platforms that allow us to sort of pick the ones that fit the right criteria, the sorts of things I talked about earlier. And then what we do is during the process of investment and portfolio construction is we create a very diversified portfolio, and that's the key to it really. So we diversify over both sector and stage. So on the sector side, we spread it over everything from edtech to proptech to AI to consumer electronics to software as a service. We've got about 10 to 15 different sectors we look at. So if one sector takes a big external hit, then it doesn't wipe out the whole portfolio. And then on the stage side, we invest in some early propositions, which have really incredible chances of return multiples, but are slightly more risky, but also some more later propositions, which are slightly less risky with slightly more modest return expectations. And then following investment, we use those venture partners on the boards of those companies to really add value. And I've danced around your question, which is how many do you think is going to fail? So I think in terms of an industry, it's normally around 30%. And I think the trick really is to try and inject as much value as you can into those companies to avoid that happening, but really focus on the very best ones because they're likely to create the returns for the whole portfolio.
And I know it's a relatively new VCT. Have you had any exits to date? Any promising candidates in the portfolio? So
you're right. So it's a young VCT. It's been going we've been investing for about 12 or 13 months. So no exits yet, but really excited by some of the approaches that we've had. So we actually get quite regular approaches across the portfolio of much larger companies that you would have heard of, everyone would have heard of, to come and sort of sniff around our companies and say, this looks really interesting, actually this could be a company we'd like. Now what we do is, we're looking at the point of investment at the future returns and the life cycle of that investment. And we wouldn't want to exit too early because the chances are if someone's sniffing around 6 months in, it's going to be worth a lot more 12 months, 18 months, 2 years, 3 years in. So we want to exit at the right time to get the right returns for our clients.
Quite right. If you find a good growth company, you've got to hold on to it, I think.
Exactly.
So how's the performance of the VCT going as a whole?
Yeah, so it's quite a young VCT, as we said, 13 months. And what typically happens, as you probably know, when you value your underlying companies in a VCT, is you hold their value for a period of time until a valuation event. So you have this kind of J-curve effect where the cost of the VCT kind of mean that the NAV goes down a little bit. I think the last reported NAV was just over 90p. And then as those valuations and that growth is recognised and you start to get some exits, it starts to spring back up. So I think for that reason, I think it's probably a really good time to invest in the Spring VCT.
And so to sum up, Ruben, I have some money I want to invest in a VCT this year. Why should I invest in the Blackfinch Spring VCT?
Well, I'll give you two reasons. So the first reason is that we are a team of ex-founders. We're supported by a group of sector specialists across a multi-asset Blackfinch group, which is a really important part of this as well. But we're also supported by this external network of been there, done it before venture partners. And then the second reason is, as a VCT, because we're a younger VCT, not only have we only made investments in companies post-COVID starting, so we're talking about companies that are looking to the future, the post-pandemic future, but also when we do have exits, the impact on the NAV will be quite impressive, which will give a better potential for potential special dividends above what we're targeting.
Ruben Wilcock of Blackfinch Ventures, thank you very much.
Thank you.